All right, the S&P 500 rallied today, so we came out of the light volume Thanksgiving week with a bullish move to the upside, closing above the highs of the past few days that surrounded the Thanksgiving holiday. So does that mean we're back to the upside now? I'm going to break down what we expect now going forward with a bullish move like we had today. I'm also going to break down a stock that may be giving us a trend trade opportunity with a little bit of a breakout on volume itself. So let's go ahead and get started. Today is Monday, November the 26th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You see we closed the day above the highs of these 2 days, the last 3 days of last week. So technically we closed above the high of the low day. Keep in mind that's how we closed. And remember after the market closed, it's more tariff news came out from the administration and put pressure on stocks immediately after the close. So it's going to come down a little bit, and we'll see what happens overnight. But regardless, going into the close, right before that tweet, you can see we still have a bearish posture and market sentiment still falling. But the momentum line spiked to a higher level than it's been this whole time we've been bearish, right? You see how the red line never did get up here, and it rarely does. You know, here it finally got up here. But we were already coming off of this low point by the time we got it, and we immediately came back down to a lower near-term low point. So this is a little different in that we're coming off of a low and we're getting that. So that's a good sign when you get the extreme momentum lines that can be trend reversal. So in this case, one to the downside doesn't matter because that's what you'd expect in the bearish posture. But you notice if we don't get the big jumps to the upside when you got a bearish posture, and we're getting one right now. So a positive sign for stocks. And you notice they also have the bullish near-term divergence with the higher lows and the blue line down here at the bottom with the lower lows here. So that sets a target for that divergence right here at 2335 in that area. So remember this divergence here that I mentioned before, you know, it hit the target. It got up to that 2800 level. So again, that's the idea. You know, we expect to move back up into this 2735 to 2750 zone in that area here. Of course, we'll see what happens, right? The near-term line, you know, if it gets above 80, then there's a good chance you can get through that on this near-term run. But, you know, if it can't and it produces another one of these, which I actually expect that we will, I expect that we still will get more near-term choppiness, kind of like this here, before we finally break out and start a bullish posture with the dark green shading. If you look at the and that's kind of how we mentioned on Friday. Like, don't get too caught up in the big moves to the downside. Don't get caught up to the big moves on the upside until we get a change in trend, right? Until we break that trend and get going in the other direction, or you break the support. You can see the Nasdaq also closing above those 3 days highs. It's got the strong bearish posture, which usually doesn't stay down there for very long. So we'll see how much longer. And now we don't have we have the bullish divergence here that sets a target right up to about 72.70 in that area. So we'll see what happens with that near-term line. It's not in the reversal zone yet. Same thing with the Russell, which also closed above those 3 days highs, with also the same bullish divergence, setting our target up for about 1530-ish in that area. And again, we'll see what happens with that near-term line. If it gets above 80 tomorrow, if we're able to solidify this bounce tomorrow and get above 80, that will be a strong sign for a posture change, which right now is currently strongly bearish, that we look for a posture change to being bullish again. You can see even the Dow now is bound below 20. So we'll see if that is that. And you can see also too, you have the potential for an intermediate divergence where you have higher lows with already lower lows on a closing basis. Market sentiment's also down too, below 50 across all these major indexes, which means, and you can see the Russells again almost got the cluster with all 4 lines down there here a couple days ago. So it means that when we do start an intermediate run, you know, we're looking for the potential for multiple intermediate rallies to come out of this, with the idea that the market sentiment has room to go up, just like it did back here for like the S&P 500 back in March and April, where it came down and then had a nice long run coming out of it because it was below 50 when we started this intermediate rally. Okay, before we look at some other charts, reminder, subscribe to our YouTube channel. Mouse over that logo right here in the bottom right corner of your screen, then click the red subscribe button that pops out. Also, click the thumbs up icon down below. That tells me two things. It tells me, number one, you got something out of it today, you liked the video. Number two, it tells me that you want us to do the video again tomorrow. So it's a quick, really easy way to give us feedback you can do right now while you're watching. Also, scroll down further below, comment on anything that stood out to you from tonight's video. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen there. Click that link to subscribe. Also, follow me on Twitter for more content like this throughout the day. And also join our Market Outlook community that we created on Facebook. Also, too, you can like our Market Outlook tweet and Facebook post down here below the video. Click this heart right there. That opens up a new window where you can like today's tweet. Click on this image. That will take you to your Facebook page. Again, clicking on those likes tell us, again, with one simple click, that you want us to do this video again. It's a really easy way to give us feedback. You can comment on the video in the forums. To participate in our forums, you have to subscribe to our site. You can do that right here for free. And of course, you can see our calendar of our upcoming classes that we have for our premium Market Scholar members. Of course, the big deal this week will be whether or not we can get back up above the 200-day moving average like we did a couple of weeks ago. Are we going to be able to get up there and stay above it? You can see we got the death cross. We got the 50-day crossing below the 200-day moving average down here with the negative. You can see, let's see here, it'd be, yeah, negative 7.85. There's your value right there. So we got the death cross. That will mean that we'll get pink shading. Now, typically when you get a death cross, it can set the low point, or it can make the return move and start the bearish trend. So that's kind of what we're watching for. Again, with all the macro factors, I still would expect us to set the low point here, similar to what we saw back in 15 and early 16. Again, back here, nobody wanted to buy stocks back here either. So if you recall, during most of 2015, well, the stocks in China lost 50%. So we had a similar bearish sentiment. In fact, the bearish sentiment, I tweeted this out. For those of you who follow me on Twitter, I tweeted out that our current bearish sentiment among retail investors is as bearish now as it was. In fact, it's the most bearish since early 2016. So again, that's when so many people are bearish, that's usually a good sign for the markets. And it doesn't take long to go through Twitter or stock twits or whatever and see the prevailing sentiment among most people is for stocks to go to the downside. All right, if you take a look at the Dow's a lot closer to crossing up above. You got the potential harami on the Nasdaq and the Russell trying to set that low point after its own death cross. Let's take a look at the 3 green arrow charts for the S&P. You can see you got 3 red arrows. A little bit of a reversal here. So what does that look like when we break the lines down? That MACD coming up off of a much higher low point than this one with the lower closes. We're still below the 8-day moving average, so we need to break up above that 8-day and break up above the 17-day before we're really, remember this, the reversals occur in stages. The first stage is for price to get above the 8-day. The last stage is for both the 8 and 17-day to get above the 30, similar to what we see over here when they finally both got above the 30. We made that run. So we'll see if and when, but right now we're still below the 8, so we're not looking for a bullish posture. And that's why I say we could still get some near-term up and down volatility until these lines compress more, similar to this, where now it makes it a lot easier to get above all 3 of them and makes it easier for the red and blue lines, red and green lines, to get above the blue. So the red and green being the 8 and 17-day exponential moving averages that are used in the MACD down here, and the blue being the 6-week moving average. So we gapped up today and got up above Friday's high point. We did come down, start to fill in the gap a little bit here in the middle of the day, but finished with a rally. Remember the after hours, we dropped back down to about right here last I saw. So keep, big grain of salt there. But you can see how we close up above those highs. So relatively positive sign from that regard. We're away from the low point of the 4-week range. In a couple of days, this is going to be the 4-week range, right? This low point right here. So we're going to be that close, and you can see the high of last week, the 4-week mid, the midpoint of the 4-week range, which will move up a little bit when this low point moves up in a couple of days, and then the purple line being the open of this week's Hakinyashi candle. You're going to meet up with some resistance in here. So if we were to continue up in the near term, that's where you're going to find some near-term resistance and get some near-term volatility back to the downside. So it's not going to be every day straight to the upside. If you take a look at the volume here and the trading range, now keep in mind there was about a $2 gap today from the close on Friday at 263 and a quarter to today's low 265 and a third. So you got about a little bit more than 2 points. The range at two and a, so you're looking at about a 4.5 point range, which is right about average when you include the gap, which you would include because that's the overnight trading, right? That's a full day's worth of trading. So you just don't see it here because it's overnight. This doesn't include the overnight. You can see the volume at about 80 million. So when you put those numbers in context, 80 million is down here, and the trading range at 4.5 points is, right about at the average, which is, not quite, well, it's a little bit more than 2%, right? 1% would be 2.67, so you're looking at about 4.3 or so for 2%. So a little bit higher than that figure. A lot of people talked about how, we didn't get a lot of volume today, and that's a good sign that we're not bouncing. Keep in mind, so back here, by the time we had the near-term volatility finally shake itself out, and we started the bullish run, you can see the average volume had really come down there. The trading ranges had really come down on the absolute basis and on the relative basis. So this is a good sign for it. It's not a bad sign for the markets to bounce when you see these lines all falling. You're not going to get, you will get big moves to the upside when the volume's high, but the volume and the trading ranges will start to taper off usually before you set the low point, before you start the intermediate rally, right? It will start to taper off as you're trying to shake out that ups, and as you form the bottom, and then you start shaking out that near-term volatility. If you take a look at the VIX, speaking of volatility, you can see we are breaking down towards the last low point that we had right before the November expiration, right about 18.5 or so on an absolute basis. If you take a look at it on a relative basis, we are breaking into the neutral zone. Now remember, that doesn't mean anything. It's breaking below 90 and holding that break. That's when, the bullish trend, that's when the intermediate run will start, and it will most likely remain intact for that 1 to 3 month period. But still, the fact that we're breaking in below 95, that's kind of that next stage, right, in volatility moderation. You get the surge, you get the bounce up to an extreme high point, you get a bounce up to bearish levels around 1, and then you finally break 95, and you'll start to trade in this neutral zone more, holding the 90% level. So, and you'll still, because it's still relatively high in the high teens, you'll still get some relatively bigger moves in the short term. Don't get too wrapped up and think the world's going to end if we get a down move in one direction to the downside, and don't think that this is start of the bullish trend. Here we go, and not a lot of people think that, but don't get too wrapped up in any moves like today where it bounces up to the upside. We're not out of this yet. We're not breaking this 90% yet. We're not breaking to new lows in volatility where you can say, okay, now we're breaking 15 on this absolute basis. Now we've got the bullish trend intact. Now we're going to be bullish here for a while. We're not there yet. So until we get there, expect more ups and downs in the short term. And then that's okay. It doesn't matter one way or the other unless you break 2600 on the downside or you break the trend lines, the downward trend lines to the upside. All right, so to summarize, the market posture still is strongly bearish. We have some bullish short-term signals, but not bullish enough to alter the trend. Bullish enough to be good signs, but we're not out of the woods yet in terms of short-term volatility. So we expect there's going to be some ups like today, there's going to be some downs like Friday, until we shake this out and that volatility makes its way back towards 15 and makes its way below that 90% mark that we see on its chart. So, and volumes, expect volumes to be smaller, expect the trading ranges to get smaller as we reestablish eventually a new intermediate posture a new bullish intermediate posture. And the question, of course, is going to be how long. Now, is that going to start here soon? Well, we'll watch that near-term line. I don't expect it would, but watch that near-term line to see if it gets above 80 in these major indexes. We probably need a pretty decent follow-through tomorrow for that to happen. Considering the start that we've had in the after hours, probably not so far going to have the sentiment for that, but of course anything can happen once volume kicks in the open tomorrow. That's probably what's going to be necessary to get that near-term line up and make its way not just towards that divergence near-term high point, but also through it to a new higher near-term high, which would then lead to expectations for a new higher near-term low point and any successive short-term pullback. So all that being said, that's what we're looking for. What do you think of that? Do you agree or disagree? Click that poll link popping out in the top left right corner of your screen. Then in that poll, click either agree or disagree. If you click disagree, scroll down to the bottom and comment down below on what you're seeing that would suggest anything different than what we just came up with going through our market outlook routine. All right, now let's transition to what's driving this price action. You can see it basically was just an oversold bounce. The biggest things that were down over the last couple of weeks here, and really, if I were to go back a little bit further and say go back to the last 4 weeks, since the end of October, and we can obviously go back more than that, but you can see equities have been trying to figure out this bounce and then pull back, and really from what would be November the 8th. Let's go to November the 8th here. From when that started, there we go. November the 8th. So there's our pullback in equity. So U.S. stocks are down more than 6%. International stocks between 4 and 5% losses. So they bounced today. High yield also bouncing. Long-term bonds have been the best performer. It pulled back a little bit. The dollar stayed strong. Gold stayed relatively flat along with foreign bonds. Crude oil, which is down so much into a potentially divergent low point here, bouncing up today off of that capitulation move that we had on the half day of trading for the broad market on Friday. So, I mean, today is lack of significant news. Now, things looked much better in Europe, and so that's why you see, from a foreign markets perspective, your best performing asset or your best performing markets were in Italy. There, of course, that's where the good news came from. Spain, you can see there's Korea and China. There's Sweden, Taiwan, of course, along with Korea and China. There's Germany and the UK. A little bit of positive news, relatively positive regarding the Brexit deal. So good news, good headlines at least, coming out of Europe, and that pushed these areas up higher. Of course, North America, or the American major markets, Brazil and Mexico, at least major emerging markets, not doing so well at all today. And then there's your SPX, which outpaced developed markets as a whole, and there's EEM would be down here getting dragged down by some of these emerging markets, including Russia. Russia also has some negative headlines coming out with some military issues with the Ukraine. So absent some of those significant headlines coming from Europe, there wasn't a lot of economic data or earnings data that really impacted investor sentiment, other than we had a very oversold week last week on a 3.5 day week. So anytime you get significant moves on short weeks or short days or with less volume, they tend to get reversed on a technical basis when full volume comes in and there's not a continuation of news to keep driving the market in that same direction. So here's the economic calendar, and of course you had a couple of things. The Dallas Fed Manufacturing Survey, which is more energy related than the others, came in below the prior figures. But when you look at all of the indicators put together, which is what the Chicago Fed National Activity Index does over here on the left, you can see the 3-month moving average moving up pretty strongly, even from a revision for the last month. So when this chart populates down here at the bottom, you see there continues to be a gradual trend higher in economic activity from a manufacturing and industrial basis. Now keep in mind, this is a sentiment survey. This isn't tracking hard data. It's more soft data, but still a rally nonetheless. If you look at this is a rolling 3-month window, so there's been some other indicators falling off the 3-month window on the other end. That must have been better than expected, because you can see the economic surprise index back down to a small negative number. So the reason why we can't get going higher is because we don't have a positive surprises on one hand. On the other hand, the reason why we're not breaking 2600 because we're not significantly bearish on the other hand either. We're kind of like flattening out, and that's usually the sign that the Fed's looking for to say, okay, we've done what we need to do. Right? They're up a little bit, still just below 40% on the odds for a rate hike in March, with the odds for the rate hike in December popping back up to about that 80% mark. Getting above 80%, that's kind of like, okay, we're set in stone. And just like being above 60% would be your kind of set in stone right now for March, and we're just not there. We're not even above 40%. So that's why, it's looking less and less likely that we'll get that after we get this December hike, they might pause. It's been a while since that next meeting, that second meeting out, has been below 40% for this long, right? And you can see that wasn't always the case. It's been more of a relatively recent phenomenon for that to happen. You'll notice up until just recently, we were up close to 60%, up over the 50% mark, and then the odds changed, right? Things changed, and that's reflected in that. Of course, GDP estimates will come out here later this week. The actual GDP estimate will come out for Q3. This is for the estimates for Q4. The revision, for Q3. The estimate for Q4 continues to be right around 2.5%. Still just a little bit over that inflation level, where you get the higher standard of living, that definition of a higher standard of living. And again, when you look at how these sectors are performing, we see a very similar situation where you have the worst performing sectors bouncing up the most today. You can see over here on the left, discretionary, technology, and communication services all rallying the most. Technology getting hit at the very end with the hit to Apple, the tariff news there. At the other end of the spectrum, the dollar holding its ground still puts a little bit of pressure on energy, materials, and industrials. Again, if the dollar were to continue to start to reverse itself, more to the downside here. Let's go to there we go. If we were to peak here and run out of this bullish momentum, then you'll see those areas, energy, materials, industrials, lead their way higher to the top. If this continues to break out and say gets above 97 and makes its way to the upside, then you'll see all those FANG stocks make another comeback, right? You'll expect them to head higher, and you'll see discretionary, technology, and communication services make potentially one last leg higher with that dollar strength. All right, one stock that in that industrial area that actually did well today, coming off of a positive earnings result here, where we had this engulfing pattern and now closing above the high of multiple days here and trying to make its way off of this to a new higher near-term high point, new bullish posture. If you take a look at like the long-term chart for Deere, getting back up above after closing below the 200-day moving average, getting back up above both the 50 and the 200. A little bit of a divergence forming on those lows, the lower lows that we've had over the past few weeks prior to the earnings. If you take a look at like the Bollinger Bands, you can see getting up in the upper half of the bands, clearing a really important support level at the biggest volume node, that orange line. Still got some resistance in this area, so it's not out of the woods yet. We don't want to be too aggressively bullish with it. But still a positive development there. And then if you look at the DMI, you can also see too, go to Deere here, that it's crossing up above the 25 level for the DI plus with some pretty decent volume today. So when you look at the three green arrows here, whoops, there we go. Deere, you get three green arrows today with the spike in volume. That's nothing's 100%, but if you're looking for something that could suggest that we'll get a break out of a sideways trend, three green arrows with a spike in volume is a signal that you would look for. They don't always point to it, but it's a signal. It's a signal that you look for to give us an idea that it could happen, right? And so, that being the case, you can say, okay, well, we've got a low point right here that we can look to buy. We've had a sideways trend for a long, long time here, and of course, industrials if they start to outperform over, any trend that we develop, right, with weakness in the dollar, then this might be your signal to be able to trend trade the stock on the three green arrows and the spike in volume and all the other signals here for a little bit of time. You can see the long-term moving averages had converged on each other, so there's opportunity for a divergence of these lines back to the upside after this convergence, with a little bit of a divergence to the downside. So again, you look at an opportunity to say buy the stock here at 148.88. There you go, 148.88, and you can buy with a stop order. And then you look at the let's see here. Where'd it go? There we are, the three green arrow chart. So we say, okay, well, there's the low point that preceded the three green arrow signal. So we can set our stop order below 136.5. Let's go take a look at how big an ATR is right now for Deere. And we say, okay, well, we got about a 5-point ATR, so we'll put our stop order at about 130. That would give us a 1 ATR move down here below. Let's see, 136.5. We'll go down to about 132. And that gives me about a one ATR stop order below that low point. So we'll come over here, set our stop order at 132. And then now there's my trade risk of how much I'm willing to lose per share. Now I need to figure out, okay, how much am I willing to lose total on the trade, and then divide this number, the trade risk, into that portfolio risk, and that will tell me how many shares we can buy. Alright, well, that does it for tonight. As always, now I want to hear from you. Click that link popping out in the top right corner of your screen. That will take you to our market outlook forums on marketscholars.com. Let me know any questions or comments you have about tonight's video. Anything I didn't talk about that you wanted my take or perspective on, or wanted to ask the Market Scholars community about, feel free to post there, and let's keep the conversation going until next time. As always, thanks again for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon and comment, follow us on Twitter, and join our community on the website, as well as our Facebook community we created. Again, have a great rest of your evening, everybody, and we'll see you all tomorrow.